Hello, May 8th, 2022. Welcome to the Real Estate Podcast with Robert Ikard. Thank you for joining us. I wanted to jump in with a little bit of an educational component today. I've had a lot of questions about different types of commercial leases. There are basically 5 different types of commercial leases. I'm going to make this quick. I don't want to bore you all to death. It's also very complicated stuff. And if you're going to enter into a commercial lease, we recommend you get an attorney to check it over for you, unless you're very well versed with it and you don't feel like you need that. But so they have a lot of different types of commercial leases. A full service lease or a gross lease is a lease where the landlord handles the additional building expenses and the tenant pays one payment, and they may have higher rental rates than other types of commercial leases because everything is encompassed in that one rate. The commercial gross lease, full service lease, like for example, many cases you'll rent. These are oftentimes more mom and pop type leases where you'll rent a space and pay, for example, $3,000 a month to rent a building, a commercial building. That's it. You have one payment, and then the landlord pays the maintenance, insurance, real estate taxes, building upkeep, and you may just pay only that one fee or rental rate. Then there's what's called net leases, and that refers to a category of commercial real estate leases that stipulate that tenants pay some of the costs, different types of net leases. So the most popular type of leasing commercial real estate is called a triple net lease. People may have heard that, but they may not understand exactly what that means. And it's essentially the opposite of a gross lease, which I was just talking about, where the tenant agrees to pay for the rent and their utilities, plus the operating expenses, such as maintenance fees, building insurance, and property taxes. These are by far the most common type of commercial leases, and they come with a reduced base rental rate, because then you're paying the operating expenses or the triple net expenses on top of your base rental rate. So those are often longer term, and it's written into the lease. And in terms of all these type of leases, they all vary by contract. A lease is just a contract. And so you can throw a term or a word at it, but you really need to read the fine print or have your lawyer help you guide you through it, because somebody may call a lease a certain thing, call it by a certain name, and it may not even be that type of lease once you get into the details. So, and especially with commercial leases, they're very customized in many cases, not like you'll find in residential leases, where you'll find oftentimes more boilerplate forms being used or standardized forms. When it comes to commercial, we do have standardized forms and leases, but many landlords have their own lease, and they put together their own lease with their own terminology. So it becomes a far more sophisticated and complicated event oftentimes to do a commercial lease. And you really do need to study it very carefully, what you're signing. They have double net leases, which is the tenant pays the rent and utilities as well as the property and building expenses, and then the landlord will pay the structural or maintenance expenses. A single net lease is where the landlord takes care of the building, insurance, and maintenance expenses, and the tenants pay the rent, utilities, and property taxes. And pretty much all of these leases in commercial setting, the tenant pays for their own, usually pays for their own electricity, internet, phone, things like that that they need to run their business on a day-to-day basis. But sometimes you'll even find gross leases where you go and you rent a place and they provide everything. I think about some of these office sharing type of things where they'll provide internet, reception, copy machines. They provide a lot of stuff underneath the lease. But like I say, they're all very different animals, and you got to look at what you're getting into each time. And then a modified gross lease is the tenant pays the rent plus a portion of operating expenses. Oftentimes with that type of lease, you'll find that you'll have like a base year, and this really gets involved, but they'll have a base year. Let's just say you moved in 2015. That could be your base year, and it probably would stay as your base year. And then you pay the difference between the 2015 taxes and insurance and the 2022, for example. So you just only, as a tenant, you would pay the increase, if any, which in 99% of cases, all those things are always going up. But then you have so that's kind of a base year lease, or you have a base year calculation. And then they have percentage leases where the tenant, requires the tenant to pay, in addition to a base rent, they pay a percentage of their revenue. So they have to share the books with on a percentage lease with the landlord. You'll see this a lot with restaurants and bars and many retail locations. They'll pay a base amount, and then sort of the landlord is in with the risk as far as if their business does well or not. And so the landlord can share in the upside of their business, as well as not have to participate not be able to participate if they're not making what they want to make, or they're not making what they doing well. Then the landlord doesn't do well. So you share the landlord shares the risk, I guess is what you'd say, on a percentage lease. And that's pretty common with restaurants and bars, and they'll get a flat rate pretty much, and then they pay a percentage of their sales, and they have to share their books with the landlord. And then so those type of leases are common in certain situations like that, but they also require accounting. You have to look at their books. You have to be willing to share your books with the landlord so they can see how you're doing, how your business is doing, and then you pay a percentage of how the business is doing. That's a quick little summary of that. It's all very involved. There's whole college courses and law school courses dedicated to these things, and it can be very involved. And so, of course, you might want to get professional help. We recommend it. I recommend it. Moving on to some of the news. So I have this article from the Wall Street Journal. Nicole Friedman, dated May 3, 2022. Home prices continued to surge in virtually every corner of the United States during the first quarter as mortgage rates rose rapidly. So many buyers rushed to lock in purchases in the first quarter before rates climbed even higher. It's according to real estate agents. So I don't think it's any secret that rates are going up. Interest rates are going up, and many people are wanting to get their home before it gets any higher. Historically, they're pretty. I mean, it's at 5.1% right now. So it's been way worse in the past, and it's been better quite a bit better in the more recent past. But so they're climbing up, and people are trying to lock in. And it says buyers are rushing to beat anticipated mortgage rate hikes. Article goes on to say home prices and mortgage rates have climbed simultaneously in recent months, raising costs for home shoppers and prompting some to reduce their budgets or drop out of the market. So many people are they're kind of comparing the costs of home ownership with renting. And as the interest rates go up, you can get less and less house because you can't afford as much of a house with the higher rates. And so many people are opting to just rent and not have to deal with the burdens of home ownership, as well as their benefits as well. So they're just dropping out of the market. And however, demand continues to outpace supply, the article goes on to say, and a persistent shortage of homes for sale is still prompting bidding wars among buyers and pushing prices higher. Okay, so that's still going on. I don't know how much longer, but it's still going on. The average rate, this is kind of shocking here. The average rate on a 30-year fixed rate mortgage rose from 3.1% at the end of 2021 to 5.1% last week, near the highest level in more than a decade, according to mortgage finance giant Freddie Mac. So that's 2 points, 2 whole points since the end of 2021. That's dramatic. That's a dramatic rise. Economists expect rising mortgage rates to lead to slower home price growth by the end of the year. It's because people are dropping out. The less people that are going to be in the market, the less you can keep on seeing these prices go up. And people are already dropping out. 2 points will knock a lot of people out of the market. And it's doing it. It says prices can be slow to respond to changes in buyer activity because sellers often wait weeks before dropping their list prices. That's one thing about real estate in general, is real estate is a slow-moving machine in many cases, which can be good. It's not always easy to sell a piece of real estate. It's not like the stock market where you can click a computer and boom, you can sell a stock. Real estate isn't that way, and that's good. Because it can often, I think it's good. It's good and it's bad. It's not as liquid as stocks, but so that would be a negative, the lower liquidity. However, that can protect an investor from, if you're an emotional, we're all emotional, but how emotional you are in terms of your investments is another story. Emotions in the stock market can drive things all over the place very quickly because people are clicking a mouse and making decisions that quickly. Real estate is not subject to that because it's a bigger deal to sell a piece of real estate or to buy a piece of real estate. So it takes weeks, months, sometimes years to make things happen in real estate, and that can take a lot of the swirls of emotion out of the equation, which I think can be a very good thing. For example, somebody may say, I want to sell this house. Look at what I can get for it. And it's not a one day you make that decision and then you're locked in and it's done. No, you might say that, and then you look at it and you think about putting it on the market, or commercial real estate for that matter. You put it on the market, then you kind of find out what the market is going for it. You see how, if you list it and see how many people or many offers you get at the price you list it at. And when all of that's said and done, a lot of time can pass. Well, during that time, you have the option of pulling it off the market, saying, oops, I think I was making a bad decision there, or maybe an emotional decision. So, and you can reverse that and not let it happen. And those are things that you can't do with other investments. They can't be so well thought out and analyzed. So that's what That's one thing I like about real estate is you're kind of protected from your own emotional decisions, which we're all, like I say, we're all emotional, but are we going to make big financial decisions based on emotion or based on reason? And we really need to make them based on reason. And that's why the real estate is more of a reasonable person's choice because it slows you down. Slows you down in buying, slows you down in selling. Here's another thing. With real estate, you often have to deal with banks. Well, that'll slow you down, dealing with a bank. And then producing financials and going through the process of getting bank approval to buy a piece of real estate. So the bank now becomes your partner, and they're going to slow you down, and they're going to make sure if you're a purchaser, that the deal is at least creditworthy from an underwriting basis. And then same with a sale. You still have a buyer on the other end, and they may have to be dealing with a bank. So yes, there are a lot of cash purchases going on out there, and there's a lot of money moving around on a cash basis in real estate. But overall, it's still a much slower moving investment vehicle than others. So here's another article about commercial mortgages. And this is by richmond.com, Andrew Little. Title of it is Commercial Mortgages. Commercial real estate investors have a case of high anxiety. And the article says, interest rates are high, costs are high, and inflation is high. So, all of which are causing anxiety for not only home buyers, but also commercial real estate investors, lenders, general contractors, and brokers. And I see that every day. I see the higher anxiety going on. Well, you'll find commercial real estate developers, builders, contractors, just at every level you can imagine. They'll give you a bid. Well, let's just reduce it to, let's just say you're getting a bid to have a commercial space built out. Well, they'll give you a bid on it, but then if they don't have something in that bid to protect them, they may worry that it's going to take you 3 or 4 months to choose a contractor. Well, prices are changing on things dramatically. So as prices change, who's going to be holding that contract and having to honor that contract if there's not some type of clause allowing for it to be adjusted? So contractors, investors, real estate investment, you make a choice about it, but now you're investing in a piece of real estate, and is it a good choice or not? Is it when you buy commercial real estate, you're not buying something because you love it necessarily, or because you want to live there or fall in love with it. It's a purely financial decision. It's a hardcore financial decision. And so you have to say, well, okay, this is what I'm going to be paying for this. Can I get enough rent to cover my costs and all of this? Well, that's all very subject to how the business world is going on. And if the world of business is weak, or it looks like we're heading for a recession, that's going to hurt you as a real estate investor, commercial real estate investor. If there's a recession, if you can't get a tenant, or the tenant can't pay the rent because their business is bad, you're very, very much married to your tenant in commercial real estate and their own financial strength or lack thereof. And so all these things that are going on, interest rates, the inflation, those things, this article says it's causing high anxiety, and it really will. It reduces stability And with things going up, the stability of your analysis, or the key metrics of your analysis going into an investment, are changing rapidly. For example, like we talked about earlier, the interest rates going from, for homes, 3.1% for average 30-year fixed to 5.1 in a matter of, what is it, 5 months? That's radical. That's radical increases. Those are radical increases. And radical number changes don't make for very, they don't give a lot of confidence to a person or institution who's trying to make a investment choice, because they're, when those numbers underlying your calculus are changing rapidly like that, it creates anxiety, as this article says, or uncertainty. So the article goes on to say, not only have rates risen to the point of choking capital that was feeding the voracious appetite of commercial real estate investors, but spread volatility has made it almost impossible for conduit lenders to hold quotes. And that's true. Lenders would like to give you a quote as well. All they're doing is selling money. That's what a lender does. They're selling you money. And are they going to sell you the money at a certain percentage of a rate? That's how they sell you it. They base it on their interest rate. And the money, as the rates climb, it's hard for lenders to get stuck in, they don't want to get stuck in a longer term loan at lower interest rates when interest rates continue to go up, because that loan becomes worth less to them if the rates continue to climb. So there is a lot of anxiety out there in commercial real estate as well as residential. And the inflation, potential recession on the horizon, I don't know if that's coming or not. But that's what that article is about. And then here's another article, dated May 6, 2022, by the UCB Journal. And it says, commercial real estate market expected to grow despite rising interest rates. So the article says, while rising interest rates are posing a risk to economic growth, NAR chief, which means the National Association of Realtors, chief economist Lawrence Yun expects the commercial market to perform well despite the headwinds, especially in the short term. And so far it has been performing well. I think we're coming out of the pandemic, and that's created a lot of interest in commercial real estate, a lot of economic activity when we were pretty much shut down during the pandemic. Now it's coming alive. And this article says, outside of the office sector, which is lagging behind as employers allow more work flexibility, commercial real estate continues to strengthen. It says the industrial sector is booming. Retail is turning positive. The hotel industry is recovering. Apartments are doing very well, and rents are rising in all commercial sectors. So that is true. In the short term, it is doing very well. And so this is a positive, however short-term analysis of how things are going in the commercial real estate world. And the fact that they are raising interest rates from an economic perspective should help with inflation and tame it. Low interest rates can fuel inflation. Higher interest rates theoretically are supposed to calm inflation. So what they're doing by raising interest rates, the Fed, is trying to tame inflation that's going on. And so in the short term, it's looking good. It's funny, they threw apartments in here into the commercial real estate. Sometimes people put them in the residential real estate world, and sometimes they put them in the commercial real estate world. It's really a commercial enterprise if you think about it. But it's but they're all doing well. Again, it says the industrial sector is booming, retail is turning positive, the hotel industry recovering, apartments are doing very well, and rents are rising in all commercial sectors. So that's very positive for commercial real estate right now. And then it goes on to say, while the overall office market is wobbly, some variance exists depending on location. And that's a lot of these articles that we talk about on this podcast are national in scope. Some are more local, but real estate is pretty local when you get down to it. However, there's national implications like interest rates. Those have national ramifications across the board, but a lot of real estate is very local. You can compare different areas of the country, and for various reasons, political, tax-wise, population trends, things like that, make it more of a local event. And it says the overall office market is wobbly. And I've seen it. You're seeing less people, less businesses, firms, companies wanting to rent entire 15,000 square foot floors or more for their business. They may want less, but the desire for smaller office spaces is really hot. But the bigger, huge offices, I think, are being scaled back, especially after COVID, and when people are working kind of hybrid schedules between the office and home. I think overall there's going to be some permanent aspects to that, because there's so much technology's gotten so much better, and you can have Zoom meetings and a lot of things that were possible before but are much more possible now with increased internet speeds and whatnot. But at the same time, there's a lot of businesses that will not thrive if they're not going to the office. Any business that relies on people and deals and making deals, you may think you can do that from Zoom, but when your competitors are down the street and they're having a bricks and mortar office and they're doing deals over handshakes, over lunches, over happy hours, over office meetings, and they're using that face-to-face interaction that can only be done in person, and they're using their office as a platform for that type of exchange. Well, if they're doing a deal because they've got that apparatus set up, and you missed out on a deal because you are going to try to do it all from computers and Zoom or Teams or whatever, then it won't be long before the people that are missing out on those type of deals are back at the office trying to compete head to head and face to face. But the world is changing. However, a lot of deals are done on a personal level. A lot of real estate deals, a lot of business deals. It's that personal factor that makes a lot of difference to a lot of people. And PowerPoint presentation over a computer can only get you so far. And it's really, and also here's the other thing. I've talked about some of this with some of my coworkers, as we'll have meetings, and we've said, this meeting would never have occurred if we were all working from home. And they're valuable meetings that happen at the office. They're valuable interactions that happen. You talk about things that You at the spur of a moment, you just pop in on somebody in their office and say, "Hey, do you mind if I ask you this question?" No, they don't mind. I don't, if I'm not too busy, I don't mind. I like people interacting with me and asking me questions at work, and that just really doesn't happen when you're working from home. I've done both, and working from home can be very isolating from that standpoint, and you do lose a lot of that um, those personal interactions that can make your business better. They can when you can interact with coworkers, it can not only can deals get done better, but just business can run better because um, you're just meeting about your immediate needs, and it's it just can be done quicker and more efficiently often if you're working together in person day to day, showing up at the office. That's just my opinion, and I think it's a lot of people's opinion. That's why you're seeing office market may be wobbly, but it says the article goes on to say we've seen improvement in some mid-sized markets as companies seek more affordable office locations away from major U.S. cities. Now, that's possible because of technology. They may say, well, do I really need a whole floor of a high rise in San Francisco? Or can I get a whole floor of a high rise in um, someplace else that's not a major city next to the coast? And they may say, well, we can get a lot of the same benefits from having an office, but not paying those rents because of technology. Um, and technology has saved a lot of money in terms of travel, but that's another thing that's happening with not just offices, but just individuals. They're finding that they can work and live, they can work for the same companies, but live in a much more reduced rate of living in a smaller city or further away city than a major U.S. city. And if you can get away with that, that's great. And companies are doing it too. Looks like from this article, they're moving to more mid-sized markets instead of the highest markets. Article goes on to say the volume of multifamily investment in 2021 was the greatest year for any asset class in history, with $352 billion of investments, according to Matt Vance, Senior Director of CBRE. So $352 billion of investments in apartments, basically, is what multifamily is, of course. And that is a lot of money going into apartments. And much of it is because it's hard to build homes in a lot of places. I just talked to a friend of mine from California, from Los Angeles, and he said, I'm trying to remember what he said, something like, I believe 60 or something percent of Los Angeles is you can't even build because they've said no building here, no building there for various environmental reasons, and or they want to just preserve it, keep it in its natural state. Well, that's great, but also they're driving people further and further away from the major city centers because there's just a lot of unbuildable land. There's multiple reasons why multifamily is doing so well. That's one reason. It's hard to build. Another reason is it's expensive to build homes, individual homes. We have markets in Dallas, Texas, where I am, and there'll be developments that are stopped cold because people rise up against them, and they don't want them. They don't want them in their backyard. They already have their house, and they don't want another housing development built across the street. And they can successfully stop them in many cases by protesting. So that's another reason housing is more difficult. And then of just cost of construction. Wood is unbelievably expensive. Appliances are very hard to even get a hold of, and in many cases, I said it in the last podcast, we have some apartment communities here in Dallas that can't even open, brand new apartment communities, because they can't get refrigerators. So it's kind of hard to tell people, we'd like you to come live in our apartment, but you got to use an ice chest. And so they're on hold. They're not moving forward because of something like not having refrigerators. So, but anyway, the volume of multifamily investments has greatly increased, and that may be a big wave of the future, is more apartments and less single family homes. And then there's also, COVID has caused a different pressure on it, where a lot of people want to live in single family homes and not apartments because of the density. So there's just a lot of pressure on housing in general in many major urban areas. And there's problems with water, having enough water. There's problems with having enough energy. I believe somebody told me recently, or I heard, that Bitcoin mining, and just in the state of Texas, takes up as much energy as the city of Houston. Bitcoin mining by people in their houses or apartments, they're using so much power, it's the equivalent of the city of Houston. I'd have to research that. I don't have an article on that, but I can believe it. They really are huge users of energy, and the city of Houston is no small city. That's probably, I think it's the fourth biggest city in the United States. So that's an enormous amount of electricity. Moving on to some international news. This is from Yahoo Finance. It says Toronto home prices fall in April as interest rate hikes douse sales. I believe also, now this is Canada, I believe Canada also passed something that said that institutional investors are barred from entering the market. So this may be kind of not a natural occurrence. It may be part governmental. But the article says, home prices across Toronto posted the second straight month-to-month decline in April as rising interest rates continued to cool off the market that was red hot throughout much of the pandemic. Data from the Toronto Regional Real Estate Board showed on Wednesday. The average Toronto home price fell 3.5% in April from March, as sales and listings declined from both a year earlier and the previous month. Prices are down 6% from February's peak, but remain 15% higher than a year ago. So overall, this isn't that alarming. This could just be a blip, because nothing can continue to go up, whether it's Toronto or anywhere. No investment, real estate or otherwise, can continue to just go up without falling, or at least have a decrease in its rate of growth. Another article here says the European Union to block Russians from buying European real estate. The European Union has added a ban on property transactions with Russian nationals to its sixth package of sanctions designed to raise pressure on Vladimir Putin or Russia. The ban is part of the EU's latest move to hit the Russian state and oligarchs, measures that will, for the first time, target Moscow's lucrative oil industry and their largest bank. It says the plan still needs to be endorsed by EU member states this week before entering into force and may be subject to change. So they're trying to put financial pressure on Russia because of Ukraine. Another article here, It says UK, Poland, and Ireland lead Europe hotel occupancy recovery. So the UK, Poland, and Ireland are the 3 European countries to achieve highest occupancy indexes that are 80% or better to pre-pandemic levels, according to the latest preliminary data from STR that will be presented at the International Hospitality Investment Forum. So as of April 11, the UK showed a running 28-day occupancy that was 80% of the comparable 2019. So in other words, they're 87% of where they were before the pandemic. And Poland is at 84.5% of where it was before the pandemic, and Ireland is at 81.3%. So this is tremendous news because the hotel industry and the hospitality industry were really, really crushed during the pandemic. And to see them recovering at this rate is very encouraging. Article goes on to say that Europe's occupancy recovery has accelerated in recent months to 70% of pre-pandemic comparables. So that's Europe in general, is at 70%. In general, leisure-dependent markets have been furthest ahead in the timeline, but there are encouraging signs recently of life returning to gateway cities that are more reliant on corporate demand. So it looks like hospitality and hotels are making a recovery in Europe, a strong recovery. So that's it for today, and thank you all for listening to the podcast today.